Someone sent me an Instagram message the other day, Vince.
Did they?
And they said, do you have an episode on listed investment trusts or LICs? Do you know what I said? No?
No, but I'll get that idiot Vince up and we'll talk about it.
I'll get Vince up and he can explain it. So, I mean, high-level listed investment companies, and I've got a bit of a presentation for those who are watching on YouTube, but you won't have to if you're in the car listening. High-level, if someone is new to the investing world and they've not heard the phrase LIC, L-I-C, what is a LIC? What's a LIC?
A LIC is what the label says, that it's a company that invests and is listed.
Right.
Now, what does that mean? Well, it's a company that you can buy its shares on the stock exchange.
So it's a public company?
It's a publicly listed company. Some of them are very big. And all it does is invest in other shares.
Right.
So it's a pooled portfolio of shares, which saves you trying to pick 20, 50, 100 shares to get your balanced or diversified portfolio.
So the listed investment companies in Australia, and there are only a handful of them.
There's a handful of material ones. There's 87 all up, by the way.
Gosh, yeah. But I mean, it's effectively a listed, active managed fund.
Yeah, absolutely. Yeah, that's a really good way of describing it. And it came about to solve a problem back in the 1920s and 30s, although they weren't actually listed back in the 20s or 30s. It was a way of letting individuals get a broad portfolio without having to go and buy 20, 50 shares. And they went to their stockbroker and they bought a share in the relevant company. They started being listed in the 60s, and it suffers from a few problems, and we'll probably come on to this, but which ETFs have largely solved.
Yeah.
The problem was that it was great for the fund manager because it was a fixed pool of capital, so they didn't have to worry about redemptions. It was tradable, so customers loved it. It paid commission, so stockbrokers loved it. And the downside was that when you wanted to sell it, you had to find someone else to buy your shares. And so the demand for the shares drove the price you got for them, not necessarily the value of the underlying portfolio. Then in the 50s or so in Australia, we got managed funds, which made sure that you could buy and sell at precisely what the underlying shares were worth, but they weren't listed. And the manager had to deal with redemption. So when you wanted your money back, they had to go and sell some shares to give you your money back. And then in the 80s or 90s, we got a best of both worlds, being the ETF, which allowed you to trade at the value of the underlying assets. You could buy them online.
The liquidity wasn't a problem.
And liquidity wasn't a problem. And the capital gains tax problem of people coming in and going out went away. So the ETF has largely superseded the technology of a LIC. It's probably a better tool. The LIC is a better tool for active portfolios. So if you want active, the LIC is probably a better structure than the ETF, and that's largely around disclosure. So LICs don't have to disclose their holdings every day.
Yeah.
And so it's hard to take, if you're running an ETF, it's hard to take a really active position because everyone can see what you're doing.
Yeah. I'll just start by, in the presentation we're going to step through, and you can see this if you are watching, we're going to talk about basically in some comparisons two of the main big LICs in Australia, Argo, the ticker is ARG, AFIC, the ticker is AFI, and then I've just kind of put a comparison of IOZ, which is the ASX 200 BlackRock Index ETF. A couple of things here. Argo started in 1946, AFIC 1936, and IOZ, that ETF was 2010, but the index has been around for as long as the ASX has been around effectively.
Except it wasn't called the ASX 200 in those days.
No, was it the
ASX,
All
Ordinaries.
The All Ordinaries, which was what, 30? No.
1800 at one point.
Yeah, really?
But it's been around since, well, as long as
the All Ords are 30 shares. Or am I?
That's the Dow.
The Dow. Oh, all right. We're going to...
Close but no cigar.
It's this is why you don't record with me before 11 a.m., Vince. But this episode, you know what, Vince? Today it is brought to you. You don't know this yet, but it is brought to you by Life Sherpa Invest. So I disclose I invest with Life Sherpa Invest. As do I. And it's effectively your company's portfolios that you use for your advice clients, but people can rock up with, start at $5,000 and put in, and they get the benefits of your IP, your portfolios, and set and forget. Keep pumping money, select their risk profile. It's pretty good.
It is. And their portfolio is largely of ETFs with some managed funds.
So there you go. You can Google Life Sherpa Invest. Otherwise, let's get into a podcast.
Let's go. Let's podcast.
You're listening to Money, 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 or as the regulars like to call it, M3. We're Australia's OG personal finance podcast. Everything you hear on the show is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I've got a book, The Quick Start Guide to Investing, and I host, produce, and curate this podcast with you in mind. You can follow me on Instagram, just search Money Podcast, or if you want to join the Facebook group, just put this episode number on your way in so we know you're real and not spam. Otherwise, thanks so much for listening. Let's do this. All right. So if we go back to our little slideshow here, Vincent, I've put together the top 10 holdings of each of the, effectively the ASX 200, AFIC and Argo. What, to me, I'll ask you first, Vince, what jumps out to you about this table of the top 10 holdings?
I mean, they are generally the top 10, so it's largely shuffling the chairs on the Titanic. It's about, I wouldn't call them index huggers, but they're very much index aware, and so that you would expect that the top 10 are largely the same top 10 in a different order. I mean, Argo's long been a Macquarie supporter, and it's not surprising to see that as their biggest holding.
Yeah, and that's actually what jumped out to me. At the start of 2025 this year, Argo had 7.3% in Macquarie. Now, when we look at the equivalent on the index, it makes up 3% of the ASX 200, where AFIC held 4.5%. And this is where, with our investing, you can't really look at the last 12 months of performance, because with a huge weighting to Macquarie in Argo, particularly over the last 2 months with Liberation Day and Trump, Macquarie has been slammed. And so that would have a material impact to that portfolio.
It would do. But if you look over the longer term, if you look over the last 20 years, the only two banks that have outperformed the overall index is Commonwealth Bank and Macquarie.
Yeah. So I don't know, that kind of stood out to me.
Yep.
You mentioned, just for the sake of educating people, you mentioned that these funds, AFIC and Argo, they're quote-unquote index aware.
Yes.
There's a style that's the opposite of that with funds management, and that's index unaware.
Or agnostic.
So talk to us about that.
Yeah, and this is part of the argument as to why many active managers don't outperform, is that in order to get a different result, you've got to do something different. And so when you're running a big fund where you're being measured against the index, so someone who's looking to buy a large, broad-based Australian large cap fund is going to ask the question, well, how do you compare to the index? And the downside of underperforming is worse than the upside of outperforming for the career of the manager. So they tend not to move too far from the index, that it's more about tilting or going overweight. So if you read the reports of a manager and they use words like tilt or overweight, you know that they're staying pretty close to the index, which makes it harder to outperform. So so in these, I would say, the choice of which of the banks you choose, which of the supermarkets you choose, which of the miners you choose to go higher than the market weight is where your outperforming is coming from. And obviously there's a cost of running these funds and a trading cost in maintaining that, and that's a hurdle that you've got to get over.
Now, just for those who are listening, I might just read the top 5 holdings of each of these 3 funds. Argo, in order of weighting, Macquarie, BHP, CSL, CBA and Wesfarmers. AFIC, CBA, BHP, CSL, Wesfarmers, NAB. And then the IOZ index, which is basically the ASX 200 weighted index. CBA, note 10% versus Argo's allocation to 4.7, so half. BHP, CSL, Westpac and NAB. So of those 15 companies that I read in the top 5 of each of these funds, there's a lot of suspects. And when we look at the performance a little bit later on in the slideshow, you will see that it's pretty much very similar when it all washes up.
Yeah. But if you just go back to that list of holdings, the really big thing that sticks out is AFIC's resources exposure is much lower. So the only resource entity in that top 10 is BHP, whereas the actual top 10 includes Wesfarmers and Woodside as well. So the actual top 200 is fairly heavily weighted into resources. AFIC's very much eliminated most of the resources out of that big group, and that will show in the cycle. Whereas Argo's got Wesfarmers, Rio, Santos. So they've got Santos instead of Woodside, which is an interesting choice. And
the Aristocrat.
Yeah, that's
that blows
an interesting
my mind.
one.
Yeah, that's very. And so there's obviously some type of longer term play or core belief, but this is where you get into, these LICs, active management.
Yeah,
that's all it is. They've got a view, they've got a reason, and they double down.
Yeah, and they are relatively cheap active managers.
Yeah,
I mean, AFIC is about 0.18, I think.
Yeah, I've got that. But it is funny because Nick Bradley, who wrote the book with me, The Quick Start Guide to Investing, he's an American.
Yep.
And he says, the ASX 200, it's a 2-sector fund of mines and banks, basically. So,
financials and miners, financials and resources,
effectively,
and materials,
whatever the two vibes things are. So let's move on. Vince, do you want to walk us through this slide?
Yeah,
and it is about volatility, and I don't expect people listening to fully appreciate this, but maybe you can just talk people through this.
It's very difficult to look at return as a single measure. What you've really got to be looking at is, what's my return per unit risk that I'm taking? And so we measure risk in that context by volatility, which for the maths nerds in the group is technically the standard deviation of the movement in the price. And so...
And just to pick you up on that, when we talk standard deviation in movement from the price, is there a general rule of thumb, but it's a monthly move, a daily move, a weekly, or is it just depends?
Yeah, most people use annualized monthly volatility.
Right.
And it's a fairly standard measure. The number itself probably doesn't mean a huge amount. It's more the direction. And so you've got to look at the two, and we generally plot that on a graph that has performance on the vertical or y-axis and volatility on the x or horizontal axis. And so you're trying to get as far to the top left as you can is the goal.
Yeah, so we want the performance.
You want high performance, low volatility.
Yeah.
Now, you can't actually have that, but what you want to do is get more return per
So
unit.
for the visual people out there, it's basically a graph with a T and a few dots around the middle
That's
of the T, the bullseye.
Yeah. And when you look at the big LICs, they form into two major clumps, which are close to the return and volatility of the index as a whole.
Yeah.
You've got the slightly lower volatility, marginally lower return group, which is your AFICs and your Argos.
It's fascinating that, they're camped together. If we look at if you look at a clock, everyone, and the middle of the clock is the middle of the T, AFIC and Argo are sitting at 9 p.m. or 9.
Which means they're delivering broadly the same returns with lower volatility.
Yeah.
And that's a good thing.
And that's why they are probably the two biggest LICs in Australia.
Yeah.
And it's probably because they have a stable long-term return, low volatility, nothing scandalous. But if we look at the clock face and you look at, say, 1 o'clock, WAM Capital.
Yeah. Now, WAM is high risk, high return. So they're very much a more aggressive investor. They'll take a more aggressive position. They're probably a little less benchmark or index aware. Their returns are a bit patchy. You've really got to pick your period. So over 10 years, it looks great. Over 15, it looks pretty good. But and obviously you can't see it on the graph, but if you compare WAM this is a 15-year graph. If you compare WAM, you get an extra 2.5% per year return, but you're taking 4% more volatility. So your return per unit risk hasn't gone up.
So why bother?
So that question is that what you want to do?
Yeah.
There are periods when it didn't do particularly well. And then at the 5 o'clock period, which is probably where you don't want to be, which is high volatility, low return, you've got Jerrell. Now, Jerrell is not really comparable to the others because it uses options to try and create a more stable income return, which obviously doesn't play well in an up market. So if you're trying to make comparisons, you're going to compare AFIC and Argo, who between them have $1 in every 3 invested in LICs. They are the 64-pound gorilla, or whatever the term is.
So just so people can visualize the clock face with the T in the very middle where the hands are.
Yep.
In this graph at 3 p.m., you've got the big two that we talked about, AFIC and Argo, in terms of smooth return, pretty good volatility. Realistically, the ideal, as you said, top left would be 10, 11 p.m. or 10, 11 on the clock face.
And it's pretty hard to get up there.
Now,
certainly in equities, it's pretty hard.
So the ASX 200 index, I would imagine it would be around that 9 o'clock.
It'll be closer to the middle, so it'll have slightly higher volatility and slightly higher return. So it's
because it is not active. They can actually take the view, for whatever reason, there's going to be a downturn in mining or something like that, and
so you would expect
pull those levers, whatever.
And there's a bit more sensitivity to market sentiment in the LIC return.
Oh, sorry.
Because they can smooth the return. So when times get bad, people go, oh, look, AFIC looks pretty stable. I'll buy some of that.
How much cash do they usually hold?
Not a lot.
Yeah. I guess, if you're investing in a LIC, you don't want to invest to have money sitting.
That's right.
There's just no point.
Yeah. So why pay nearly 0.2% to manage cash?
Yeah.
So I think that's the interesting story. So $1 in every 3 goes into AFIC and Argo. They're big, large cap, value managers, benchmark aware, low cost, diversified. So there's not a lot to dislike.
There's no story here, is there?
Well, I mean, the big reason we don't use LICs at Life Sherpa is because of the added complexity of the price movement around net tangible assets.
Okay.
And that's I mean, we might not hold, I don't know if you want to hold that for later.
Yeah, we'll
but
just
that's the main
pause on
reason
that.
we don't.
Yeah. But we'll come back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
Before we get back into the show, I'd like to encourage you to protect your financial life. Now, what does that mean? It means having income protection insurance in place. It means having death cover in place if you do have debt or dependents. It means having your suite of personal insurances sorted. I know you insure your car. I know you insure your house. Why not insure you? I really want to encourage you to reach out to Sky Wealth. They support the podcast. They are specialist financial advisors who can look at your situation, walk through a heap of options personalized to you. It's usually far more comprehensive and competitively priced than going direct to your super fund. You must see a specialist financial advisor for your insurance. You can head to sky.com.au, that's skye.com.au, to book a complimentary 15-minute chat and the team can point you in the right direction. Like all good cults, we need a place to hang out together. That's our Facebook group. If you are going to join the Money podcast Facebook group, just put "you heard about the group" through the podcast and put this episode number that you're listening to. That way we know that you're not a spam account. Otherwise, you can catch me on Instagram at moneypodcast.aus. Thanks so much for listening. Thanks to Sky Wealth. Let's get back into the show. Okay, so before I just pressed the break button, I said, look, is there a story here? Because on the face value, and we look at it, they're cheap, you got ASX exposure, there can be ways to easily spot discounts and effectively
it's very public information.
Good buys.
Yep.
So back to when I said there's no real story here when you zoom out, but if you start to zoom in and actually have a look, you might create a story.
Yeah, I mean, that's the challenge for us is, and we talked about this briefly as one of the problems that ETF solved, was a LIC, there's a fixed number of shares on issue. So fixed pool of capital. It's great as a fund manager because you can manage your portfolio. You don't have to obsess about being able to get cash today. But the downside is that when you want to sell your AFIC share, you've got to find someone else to want to buy it. And so when the number of sellers exceeds the number of buyers, what happens? Well, the price falls.
Yeah. And just pause on that as a teaching point. When we see stock market indices dive in one day, it's because effectively the people are like, I'm not buying. It's too crazy. Trump's just announced this, not buying. But there are, because every day there's market transactions, right? You've got portfolio managers that on this day, every day they need to rebalance, they need to trade. And when there is no people to buy and supply increases and demand decreases, that's when you get a better price.
Yeah.
Cheaper.
And that's
and that's good if you're buying.
It is.
But if you hold that asset or are trying to sell, that's not great.
That's right. And so with the LIC, if there's more sellers than buyers, the price falls, and it can fall by more than the market falls. So, or it can even fall when the market goes up. So the underlying assets held by AFIC will change with the market broadly, but the price of an AFIC share is driven by the demand. And demand goes up usually when people see the manager outperforming. They often see it based on personnel changes.
Yeah.
And the opposite happens when people see underperformance. And so you get this, you've got two movements happening here. You've got the market movement up and down and the manager performance relative to that. That's your underlying net tangible assets, if you like. And then you got the price of the LIC share itself. And the
shell.
The shell. And the two move differently. So, and generally, over time, LICs tend to trade at a 5 to 10% discount to the value of the underlying assets. Now, you might say, well, if I can buy $100 of shares for $95, why wouldn't I do that? And the answer is that, well, if you're going to buy it for 95 and sell it for 95, that's the same as buying it for 100 and selling it for 100. So it's only the movement in the discount that matters. And sometimes they trade at premiums.
So any comments, if we have a look here at the pricing mechanism, do you want to maybe explain to people what when they see NTA and NAV stands for?
That's a great question. So when you look at any fund, whether it's an ETF or a
managed fund
or an LIC or an LIT, which is a listed investment trust, the assets that they hold have a market value. And if they're...
So people may not have heard of LIT.
Okay.
So that's a property trust, basically, a REIT.
Yeah, it's a listed investment trust. In Australia, they tend to be more property oriented. Yeah. In the UK, it's used to be the default.
Well, it's the UK, the motherland of trust land, isn't it?
That's right. So
anyway,
you can sort of ignore them, but basically, it's a pool of underlying assets. In this case, mostly shares.
Yeah,
and those shares, their value changes every day, and that's the assets of the fund. So you divide that by the number of shares, and that gives you the net asset value per share. We usually use net tangible asset to exclude any goodwill that the manager might have or other things like that. So NTA is the short number, or NAV, and you can broadly consider, for most practical purpose, they're the same thing. They're technically not, but for practical purposes they are. And so you look at the share price times the number of shares is the market cap, and then you look at the underlying portfolio, and that tells you the net asset value, or NTA. And usually in a LIC, they trade at a discount. So the NAV or NTA is usually greater than the market cap. Yes, greater than the market cap. And the challenge for an investor is it's the change in that discount or premium that adds complexity to this. So not only do I have to worry about, well, what's the underlying assets doing? I said, well, what's the premium discount doing as well? And that's why we don't.
But it is a mug's game chasing the spread on the premium discount when you've got LICs, surely.
Yeah. Well, it depends. I'll
just say you're stepping over. Well, are you an investor who are buying and holding for the long term, or are you trading to get quick wins?
Yeah, I mean, there are trading opportunities.
Yes.
And quite often...
Which trading generally can be a mug's game.
It can. Especially if you're not doing it as your full-time gig. But there are opportunities where, a manager's got a bad reputation. There's a activist shareholder on the register. So the good old... Wham guys, what's his name? But he's a very activist manager,
right?
And there you can pick up some problem, but you've got to know what you're doing. You've got to be on this every day. That's a trading opportunity rather than investing opportunity.
Exactly.
So I wouldn't be obsessed too much, other than the direction of it. So if you see the discount blowing out, that's a sign that the market's thinking, well, maybe I don't like this fund as much as I used to, and you got to think, well, what's the catalyst to turn that around?
I want to talk sexy, and I want to talk taxi.
Yep.
Tax. Now, I actually did have a slide and a table. I'm like, no, it's just way too overcooked. Yep. Let's just talk tax. LICs. We've got an actively managed company that – okay, just on that, I digress. The answer is probably no, but it could be yes. Is Berkshire Hathaway a LIC?
I would say that no, its primary business is as an insurance company, and that the investment portfolio is employing the capital of the insurance company.
But if I look on an angle and squint a little bit,
Yeah,
I could be confused.
you could make that argument.
And I did make that argument.
Yeah. I mean, it's a perfectly reasonable argument to make. But when you look at where the profits come from,
he renovates companies.
yeah, which is really about putting to good use the capital that you have to have sitting around as an insurance company.
Just on that, so if the LIC is an actively managed company, so when it comes to tax, compared to an ETF, it's a product. It's got a PDF, product disclosure statement. This ASX 200 ETF, we pay distributions twice a year. Here's the freaking dates.
Yep.
What comes in, it's going to get spat out, done.
Yep.
Okay? I'm just going to throw a whole heap out and I'll let you rip. And when I do this signal, Vince, wrap it up.
Yep. Cool.
The LIC, can there be some, I don't want to say, I'll say razzle dazzle.
Jiggery pokery,
where, okay, we've got this, we've sold a portion, we don't want to pay out this as a dividend next month because we're going to do this with it. We can cook the books a little bit with CGT. Can there be some black magic within the LIC? And maybe I'll just throw to you now. I'll shut up. But talk to us about tax.
I don't know if I'd use the word black magic, but there's a fundamental structural difference that you've got to get your head around. An ETF and a managed fund are both trusts.
Yes.
An LIC is a company. Now, that might sound academic or esoteric, but from a tax perspective, it makes a fundamental difference. So a trust doesn't pay tax in its own right. All of its income and expenses, I suppose, are attributed to its unit holders. So,
which is the same in trust land, effectively, if you've got a unit trust.
Yeah. So managed funds, ETFs, they're both trusts and they are ignored for tax purposes. So the
beneficiaries pay the tax.
Yeah, which in the case of an ETF is the unit holder.
Yeah.
And so that means that there is full pass-through of what happens inside that trust box to the unit holder. A company, on the other hand, is a taxpayer. So a LIC will pay tax, and then through the miracle of franking, the benefit of that tax paid is passed on to the shareholders with the dividend. Companies are not obliged to pay a dividend. Usually they have a big incentive to do so.
And I think that was my comment, like on a year-on-year basis, if we can see something on the horizon, they might go at the AGM, hey, friends, we're not going to do a dividend in the next 2 years.
Yeah,
they probably wouldn't, but
and certainly,
they've got that discretion.
And certainly that would definitely create a discount to net tangible assets. But that's a fundamental difference. And what that means is that the distribution you get from a trust is a bit more variable because it depends a bit on what's happening on the market. So
you just get spat out what you're given.
So in a year where you have a big exit from the market, from the index, so when Westfield left the index, all of the trusts, all the ETFs who hold the index had to sell that down, create a big capital gain in that year, and you got a big distribution.
There was a capital nature.
Which was largely capital. But the point being is that was a blip. I can't remember what year it was. I don't know if you can either.
Oh, it was 2010s?
Yeah, I would say it's a decade or more ago. Similarly, when Sydney Airport was privatised, it left the index. They had to
Westfield delisted, 2018.
Okay.
Oh, gosh. Okay.
Well, it's almost a decade ago, I suppose.
Well, yeah. 8 years.
Whereas a LIC, they're not indexes, so they can choose whether to sell or not, and they can choose whether or not to pay that profit out as a dividend. There's a fair bit of incentive, though, to the extent that they have franking credits, to pay them out, because when you look at their balance sheet, the franking credits don't turn up. So they pay some tax, their NAV drops, and that's a potentially complexing thing, which also makes comparing returns difficult.
Yeah, and we will get to returns. But so what I'm hearing, and maybe I will just put up this return slide because it does come into this tax thing. When we are investing, we're investing for the long term. And when we look at the performance of Argo, AFIC and IOZ, they're very similar. So we've January 2000 to April 2025, Argo did around 8.5%. AFI did around 8.7%, which you'd call 8.5%. And the ASX 200 did around 8.3%. Mind you, an index, Vince, will always an index fund will always perform unless the index after fees.
Yep. Almost by definition.
Yes. So having said that, because of the tax and the franking credits and the CGT treatment, it's really hard to get a good grip on what the actual performance has been. Is that a fair statement?
And comparing pre-tax performance, which is what you're looking at here.
Yes.
So when you look at a performance report, it excludes the value of the franking credit. And
there wouldn't be many super funds that would allow LICs, would there? Can you get some like must trusts that would?
Probably.
Anyway, I digress. When we do the episode on retire right on wraps, we'll touch on that.
So the index itself, that's a raw return. So there's no value applied to the
benchmark,
franking
if you
credits.
will.
It is. That's all it is. There's no costs in there. There's no taxes for transaction costs. And so when you receive that 8.3% from the index, assuming you could buy the index, you will also get some value for the franking credit. So if your tax rate is less than 30%, your after-tax return will be higher than your pre-tax return. And that's not shown in these numbers. Now, when AFIC holds, let's say they hold the same shares as the index itself, they will pay tax. And to the extent that they get a franked dividend, that's largely a neutral effect. But where they get a non-franked dividend, they will pay tax. So the AFIC raw reported return has, on average, more franking attached to it.
But a real life example of that is you pull up any super fund, and this is just an example of the tax reporting and franking credits. Look at the find a Australian shares imputation fund or income fund. Look in the accumulation return the last 10 years, it might say 11%. Go to the pension fund, it might say 13% because it's factored in those franking credits.
That's right. So because that turns them into cash once you lodge a tax return.
So again, if we zoom out, the returns are very similar, and it also depends on the return of the Argo and the AFIC, what your individual tax return is.
Yep.
And does a company, do you have an investment company that owns the LIC? Do you own it personally?
Yeah. And it also depends on the nature of the LIC. There are some things called traditional LICs, which is largely what we've been talking about, where they get to pay the franking credits and they pass on a credit for the capital gains.
So I guess in finishing, the MERs, which is the management expense ratio, face value around 0.15 for Argo, around 0.14 for AFI, 0.09 for IOZ. If you had 10,000 invested, that's $15, $14 and $9 respectively. In my world, that's the same. In my world, that's free.
It is vanishing close to zero.
Now, question, with the listed investment companies, can the fund managers or the board, can they pay some type of director fee or something like that and move things around?
Yeah.
And
Yeah, there are some costs on the AFIC P&L that don't get counted in the MER. So if you actually took look at their annual report and divide profit by funds under management, you'll get a slightly bigger number.
Yeah.
The last time I did it, it was about 0.03 difference.
Yeah.
So as you say, these numbers are all vanishingly close to zero.
Yeah.
And it's not something you would use to choose one from the other.
Now, on the YouTube, we I've got this slide up, some pros and cons. I'm not going to read them all because I don't know if it matters. And I think my question in the rapid fire finishing for you, Vince, one, should an ordinary investor, if they're not listening to some financial people or reading some financial books, entertain LICs in their portfolio in this day and age? Full disclosure, I don't own any LICs myself.
Yeah. I mean, we don't hold it, and that's for two reasons. One, when you're talking about large cap equities, active management is demonstrably not value adding. Unless you
commodity.
So for that reason, we don't do active management of large caps, and therefore you get pointed to the index and you want to buy an index. The advantages of an ETF win every day.
Yeah.
If I do want active, we use active for small companies. So there
Would
are
you not just use, if you were going to go down the active road for Aussie equities, why wouldn't you just do unlisted managed fund?
Exactly. There are some marginal administrative benefits. So if you're trying to do this yourself, a LIC is probably administratively easier. So
if you had bought a LIC on a superhero platform or a B Shares Direct, it's going to do the reporting for you. Yeah. Whereas if you bought an unlisted managed fund, you're in that same boat as buying a direct share.
Yeah. And many of
them
have minimum holdings. So some of the small cap
maybe
managed
20K.
funds we use 50,000.
Right.
20, 50.
Yeah.
10's fairly common. But that means it's pretty hard to put 5% of your portfolio when you've got a $5,000 portfolio into one of these funds. So that's really why we don't use LICs. I personally don't. But once you move away from the large cap equities, there are some opportunities, but that's probably a story for another day, and that's not where the money is in LICs.
Any final comments about LICs versus ETFs? I think anyone who's listening would probably get the view that I'll call it a technology or a style that really is outdated.
Yeah,
It's the risk of
obsolete
the
technology.
board of Argo and AFIC having an aneurysm hearing that. But I think obsolete could be the word.
Yep.
Although if you are a gentleman who gets on the odd podcast every now and again and praises them forevermore, amen, it might be better for that person if they're retired from the workforce.
Maybe, yeah.
Maybe, I don't know,
yeah.
in terms of the dividends or the tax treatment.
Yeah, and if you're happy with the movement in the discount premium.
My final question to you, Vince, should we want a return, like if you woke up of a morning and you're like, I just want to invest in the Australian share market. Should we want, as an investor, or seek a return as an investor above the market?
Well, you sort of can't if you believe that a market's efficient. Sorry. Well, the way to get a higher return than the index is to take more risk than the index. So you should, in theory, be able to beat the ASX 200 by buying numbers 101 to 200. You should be able to beat the index by buying the more profitable companies.
But along with trying to get a higher return comes with potentially high risk and high volatility.
Yep. And return is payment for risk. So if you go buy all 200 in proportion to their things, then to beat that, you've got to do something different. And to sustainably generate higher return, you have to take a sustainably higher risk. And is that what you want to do? That's my take on it.
Thanks for the chat today, Vince, on LICs and ETFs. If you've got any comments about LICs or ETFs that we either missed in the episode today or you want to add, pop them in the comments here on YouTube or pop them in our Facebook group. Remember, if you are joining our Facebook group, just put, where did you hear about this? When it says that, just put, I listened to Vince and Glen on the podcast, because then we know you're an actual person and not a spam farm somewhere around the world.
We don't want bots.
We don't. Vince Scully, thank you so much for joining us today. Thanks for taking care of some of my wealth on Life Sherpa Invest. Thanks, friends. Bye.
Invest early, invest often.
Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities, to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective licence holders.